So welcome back. We are now in segment 6.15, and in this segment we'll be discussing about intangible assets. So if we see our journey so far, so what we did, we have started with all the liabilities items. So in chapter 5 we have discussed all the items on the P&L account. So in chapter 6 we have started the balance sheet discussion. The balance sheet can be broadly classified under liabilities and assets. So under liabilities we discussed various items, right? The items were broadly classified under owners funds, term liabilities and current liabilities. We discussed all these items under liabilities. Then we said on the assets we have some similar classification. We have some current assets, fixed assets, non-current assets and intangible assets. So far we have discussed current assets, fixed assets and non-current assets. So in this segment we'll be discussing about the remaining portion of the remaining item, that is the intangible assets, and with this we would have completed all the items in the balance sheet. Okay. So there are three items that can usually come under this intangible assets. These are the three items you normally encounter under the intangible assets. One is the goodwill, patents, trademarks, and copyrights. That is one item. Second is the preliminary expenses to the extent not written off, and finally I have the accumulated loss. This is the debit balance in P&L account. Now, when we discuss about goodwills, patents, trademarks, and copyrights, please understand this is an advanced accounting topic. This, in fact, accounting of intangible assets is a very advanced topic and not normally for beginners. So we will not get into a lot of depth into it because these are something which don't have physical existence. Unlike land or building or machinery, these are not something which exist, right? So, but they add value to the business. Say, for example, when we have a company, say Coca-Cola. The Coca-Cola is a huge brand, right? It has some brand associated with it. When the name itself Coca-Cola has got some brand. So when you do valuation for the company, when you do the valuation, if somebody wants to, so if you have a lot of money and you want to buy this company, so you just can't go to the company and say I want to buy a company. So what are all the assets you have? I will purchase. So what is your land? How much land you have? How much buildings you have? How much machinery you have? What are the various bottling plants you have? Right? You just can't add up and say you arrive at some figure and say I will pay this. There is something more to this. The brand itself carries some value. So when you do valuation of a company, there arises always what is known as goodwill. Right? This is a goodwill to the company. The mere addition of these physical assets will not be sufficient to buy this company. The brand of the company itself has got some value, though you can't quantify it. Right? You can do some exercises and do some valuation, try to value that intangible nature of that branding and all. But there is that amount, right? There is something called a goodwill, right? Similarly, these patents are something where you own a particular product, where you own a particular process. You are the exclusive holder of that particular product or process. So no one else can manufacture that product, or no one else can have that process. Similar trademarks, copyrights, so all these are intangible assets because they don't have a physical existence. So usually what you normally see is the goodwill. Goodwill is something that occurs in the case of amalgamation, right? Business combination. This mergers and acquisitions, again, it's an advanced concept, but that is where you actually get this goodwill. The point is, when you purchase, the purchase consideration is more than the fair value of the identifiable assets. What we are saying is, if the value of the assets net of liabilities is say 100 crores, but you actually paid some 150 crores to purchase that company. When your purchase concentration is more than that, so what you do, that 50 crores is what we call as goodwill. So this is an intangible asset. So only only purchase goodwill will appear in the balance sheet. There can't be any self-generated goodwill. Anyway, this is not something which you need to get into. Also, there will be many valuation methods for goodwill. What I'm saying is, it's an advanced topic. So what you need to know, from a banker's point of view is this depreciate. This is amortized over a period of time. So in the balance sheet, so under the assets you have an item called intangible assets. Say it is some 10 lakhs, small amount for a purpose, but let us assume that is a small amount, 10 lakhs. So what we're saying is, if this balance sheet is on 31/3/2013, so the next year balance sheet, this amount has to be written off to some extent. So maybe it becomes 9 lakhs. Maybe then it becomes 8 lakhs in the next year. So slowly you're going to write off. Just as if you remember, when we discussed about fixed assets, we had something called depreciation. So what we did, we slowly depreciated the value of the machine, and ultimately it becomes zero. So for example, if we purchased a machine for 2 crores and we said that the useful life of this machine is 10 years, under straight line method, what we did, every year we depreciated 20 lakhs. So next year it is going to become 1.8, 1.6, and finally after 10 years it's going to become 0. So we have depreciated that value over the useful life of the asset. Slowly we have written out that entire value. Similarly, intangible assets also, if you have an item under intangible assets, say for example 1 crore, slowly you're going to write off this. Ultimately is going to become 0. You have to write off that ultimately, right? So you have to understand that this item is amortized. In fixed assets, intangible assets, we had a term called depreciation. In case of intangible assets, we use the term what is known as amortization. So in case of the asset is tangible, when you write off what we call that amount, is known as depreciation. That writing off is known as depreciation. In case of intangible asset, that same concept is known as amortization. Okay. So this amortization usually appears in the P&L, and you're usually going to classify it as a non-operating expense. Amortization is usually classified as a non-operating expense. Some people add it to depreciation, right? Some people classify it as a depreciation and take the combined figure. Some take it as a non-operating expense. This makes more sense. But anyway, once again, refer to your seniors in your bank, what they are doing. It varies from bank to bank. Usually, you can classify it as a non-operating expense. Okay. Then in the balance sheet. So if you refer to our earlier example, if you remember an example of Sun Pharmaceuticals, there we had an example where in the fixed assets, right, this breakup included some intangible assets. So you have to show that, you have to understand that so intangible assets are also shown along with the intangible assets in the fixed assets. So in the fixed assets schedule itself, so in the fixed assets, the intangible assets are also shown. But there is one item that is actually shown separately, that is goodwill. Goodwill is usually shown on the intangible assets. So again, all these are accounting concepts which you need not get into, because it's actually a very advanced topic, right? Accounting for intangible assets is an advanced topic. But the point you need to remember is that amortization part, please classify in the P&L either depending on your bank policy, usually non-operating expense, or club it with depreciation. That is one part. In the balance sheet, this appears under the intangible assets. In the CMA data, this appears under the intangible assets, and slowly you have to write off. How much you're going to write off? Slowly it becomes 0, right? So the third point which you need, this is the first point, this is the second point. The last point you need to remember in case of intangible assets is always deducted from net worth. To arrive at net worth, you have to, it is a formula of capital plus reserves. Usually it is capital plus reserves, but then if there are intangible assets, you have to subtract intangible assets. So tangible net worth. The word tangible means we are not considering intangible assets. So capital plus reserves is the normal formula for net worth. But if you want to get tangible net worth, when we say net worth, as a banker, you're usually interested in tangible net worth. To arrive at that, you just deduct the intangible assets. So look at the balance sheet. Are there any intangible assets? So you deduct that from capital plus reserves. You'll arrive at what is known as tangible net worth, right? So one more intangible asset could be preliminary expenses to the extent not written off. So before the commencement of a business, even before the company has started business, there'll be it has to incur some expenses. What are these? Say company registration fees, or preparation of the project report, right? Or a market survey. So there are consultancy charges. So there are some expenses to be incurred even before the business has commenced. These are known as a preliminary and pre-operative expenses, and these are shown as a asset in the balance sheet, right? It's an intangible asset, and it's be just like a goodwill is going to be written off over a period of time from the profits, right? This is also an intangible asset. Preliminary expenses is an intangible asset. So if you find this item, what you have to do, you have to deduct it from the net worth. Net worth is capital plus reserves. So when you find this item, intangible assets, you have to deduct the intangible asset and arrive at what is known as tangible net worth. So one more item is the accumulated loss. This actually we discussed earlier, right? This is something which we discussed under reserves and surplus. If you refer to a discussion on reserves and surplus, there we discussed that if the reserves and surplus becomes a negative, right? If the company has some loss, say for example, the capital of the company is 100 lakhs and reserves is some 200 lakhs. Now the company has made a loss of say 50 lakhs. So this is previous year figures. The company has 300 net worth, 100 in capital and 200 reserves and surplus. So in this year, when the company has 50 lakhs, what will happen? This reserves will come down by 50. So 200 become 150. If the company next year makes 100 lakhs loss, then this becomes 100, capital will be still 100. This reserves will come down to 50 because the company has made a loss of 100 lakhs. In the next year, if again the company makes a loss of 100 lakhs, you have to understand that you will show the capital as still as 100. Reserves you won't show as minus 50. Instead, you will show it as under the asset side as an intangible asset. Is the debit balance. The debit balance, if the reserves and surplus becomes negative, the profit and loss, the surplus, usually we call it a surplus in profit and loss accounts. But if it is a debit balance, the negative figure usually we show it under the asset side. That was till recently. Till recently that was the practice. But now there is a revised schedule 6. The revised schedule 6, as per the revised schedule 6, you have to This is the format that is now adopted by the all the companies from 2011-12. As per this format, the debit balance in the P&L account is to be shown as a positive under reserves and surplus, right? It has to be shown as a under reserves and surplus, right? As against the practice of showing a positive figure on the other side, now you have to show it as a negative figure. So even though you have a reserves and surplus negative 50, show it as a negative 50, right? This is as per the balance sheet presentation. In the CMA data, this is not yet implemented, right? Because CMA data is not something that is updated every now and then by anybody. CMA data was a format that was used long time back, right? It was introduced by RBI a long time back, and banks are still voluntarily following it. Right? This format is not something sacrosanct. Banks can change it as per the requirement, but banks are following that format. So in this old CMA format, you have this intangible asset. Here you have accumulated loss. This is the debit balance in profit and loss account. So you can continue showing this. So it's the companies while submitting CMA data will continue submitting this, and you can take this. In the net effect, anyway, it will be reflected in tangible net worth, because you are interested in tangible net worth. Anyway, you detect the item appearing under intangible assets. So even though it doesn't appear in the CMA data here in the reserves, because you deduct the intangible assets, anyway the net effect will be the same. Okay, but if we have access to the CMA format where you can edit it, you can edit and show it as a negative figure under the reserves and surplus itself. Okay, but in the earlier cases, in the earlier years, you have a item called accumulated loss that appears under the asset side, under the intangible assets. So what you have to do, you have to deduct it just as any other intangible asset. While arriving at tangible net worth, you have to add capital and reserves and minus this intangible assets, right? So with this, we have completed all items under assets. There are a few more items which we didn't cover. These occur very rarely, but anyway, I will just take you through this. One, you can find an item called fixed assets held for sale. So where do you actually classify fixed assets? So in the CMA data, you have current assets, fixed assets, non-current asset, and intangible asset. So when you have a fixed asset item, straight away you have a separate space in the CMA fixed assets. But sometimes you have identified a particular asset for sale. So maybe this is an old machinery. So as on 31/3/2014, as on the balance sheet date, you already identified a particular machinery. Out of the total fixed assets of 100 lakhs, there is some machinery whose book value is 10 lakhs. Right now you want to sell this. You already identify this machine. You have not sold it as on this balance sheet date, but you already have plans to sell it in the next year. Maybe in a couple of months you're going to sell it. Maybe by June 2014 you're going to sell it. So when you have identified a fixed asset for sale, right? So now you have to move it out of in the CMA classification. You have to move it out of the fixed asset. So in the fixed asset you show only 90 lakhs. Then in the non-current asset you push this 10 lakhs to the non-current asset, because this is something which is not going to be a part of fixed asset in the next year. So you have already identified to sell it. So push this 10 lakhs to the non-current asset. So fixed asset held for sale is classified as a non-current. So one more item you can find is export incentive receivable. So if the company is certain, say reasonably certain that the incentive will be received within 1 year, it can be treated as a current asset. Otherwise you classify it as a non-current asset. Usually this is a current asset. Then franking and stamps on hand is also well, these are modes of payment of stamp duty. So this is always a current asset. Okay. Then there is something called impairment. Impairment means there is a weakening in value of the asset. So the value of the asset decreases. It is called impairment, right? It is applicable only for fixed assets and intangible assets and not to inventory. So actually there is a separate accounting standard called AS28 which deals with impairment. So what actually this standard says is the assets are to be carried. Right, the assets have to be carried at no more than the recoverable amount. Right, at no more than the recoverable amount, they should not be carried at if the assets carrying value exceeds the amount that could be recovered, then what you're going to see, the assets are said to be impaired, and then as per this standard, you have to make an entry. You have to make a entry. No, what is known as provision for impairment loss. So there you encounter an item called provision for impairment loss. Then what you do, you show it as an expense in the P&L account. The provision for impairment loss will be shown as a expense in the P&L account, and in the asset side, you are going to the carrying amount is going to be replaced with this recoverable amount. Anyway, this is an item that is not usually going to be encountered, so you need not worry too much about it. But in case you encounter it, please classify it as a reduce the carrying value. Please reduce the carrying amount by this value. Okay. Then there's materials, contractors and fabricators. So in business, in certain businesses, maybe the company will outsource. Maybe will send its products to some other contractor. Say for example, this is a jewelry shop. So it has some various gold and other items. So maybe there are some designers outside. There's some workers maybe in Surat or some place. Then they'll send this material there. As on the balance sheet date, when the auditors take a stock of the inventory, this is not just the stock they have. The company also has stock somewhere else. This is also the company stock. This is not something that belongs to the designers. The designers will work on this gold, and the finished product, the design product, will be coming back to the company. So this material with the contractors, fabricators, or any outside parties, this is also to be clubbed under inventory, because this is also a part of inventory, just that it is not in the factory premises, in the company premises, but it will come back, right? So you can, it is similar to goods in transit, right? We already discussed a item called goods in transit. So what is that? So goods are dispatched by from the supplier, but they didn't reach us. They are in transit. So this is not in your factory premises right now, but it's going to come. It's going to come shortly. So that's also inventory. So similarly, material with contractors and fabricators is also clubbed under inventory. Then there is something called retention money. This is actually in case of contractors. So what happens is, when the bill amount, say for example, the company is a contractor is executing a work for 12 months. So this particular work takes 12 months. So maybe this company this company maybe will pay every month bill. So for 12 months it will pay every month some amount. If the contract is worth 1200 lakhs, maybe every month the company will pay 100 lakhs. We're assuming that the contractor will complete 100 lakhs worth of work every month, and will raise the bill, and he'll get the payment. So what happens is, the company may not pay this entire 100 lakhs. Maybe it will retain. So maybe the company will pay only 95 lakhs, right? Maybe it will pay on 95%, and balance 5% it will keep aside. It will not pay the 5%. So maybe so the 5% will cut so in the next bill also it will pay some 95 lakhs. So what the company is doing is, it is retaining, right? It is retaining some amount. This amount is known as retention. So usually retention money is classified as a non-current asset. Okay. There are some who classify it is since it is part of debtors, right? In the sense that the company has raised a bill of 100 lakhs, it's got only 95 lakhs. So this 5 lakhs the company has retained is going to come back. So some classify it as a debtors, but actually it is a non-current asset. Please classify it as a non-current asset whenever you see this retention money. Okay. So these are some items that these are rare items which you're not going to come across very frequently. Retention money, of course, is something which you can come across frequently. But anyway, so with this we have come to the end of this segment. So far what we have done. So what we have done so far is we have discussed all items that can appear under the both liabilities and assets, right? So in chapter 6, in this chapter we have completed all the items that can appear, you can possibly come across in a balance sheet for under assets and liabilities. Chapter 5 we already completed P&L account. So in the next segment what we'll do is we'll take an example of a company, right? And then we'll take the balance sheet of a company, right? And then we'll convert it into CMA format. So we're going to take each and every item that will appear in the balance sheet of the company and convert it into the CMA format. We'll see where each item has to be placed in the CMA, which column, which row it has to go, right? That we'll do in the next segment, right? See you then.